Good morning. We're here with CEO William Crossland of Thermal Energy. Take it away.
Yes, thanks, Dan. And thank you to everyone for taking time out of your day to listen to the Thermal Energy International story. Thermal Energy International operates in a proven, profitable, sustainable marketplace. We do deliver energy efficiency and carbon emission reduction technologies to our large multinational clients. And the market is very strong right now, and I believe we have a very compelling valuation. So let me jump into it. Okay. So forward-looking statement caution, of course. And just quick summary, compelling investment opportunity. We operate, as I mentioned, a fast-growing global market with very strong fundamentals. And the fundamentals in this market have gotten even stronger over the last 12 months, the last 6 months. Virtually every country and every company in the world, a major country in the world has set new aggressive carbon emission reduction targets. That's driving our growth. And not only that, but on the investor side, there is growing demand for ESG, environmental, social, and governance investing. So good demand for our company. We're an established company with a proven track record of growth and profitability, something unique in the clean tech sector, certainly unique in the carbon emission reduction business. We're profitable with a 30% plus 5-year compound annual growth rate prior to COVID-19. And we got an extensive list of multinational customers. We generally deal with very large multinational companies that have hundreds of sites around the world by design. That's part of our strategy. And despite the very strong market that we're experiencing right now, and despite our established track record of growth and profitability, I believe we're currently at a very compelling valuation of about 1.2 times revenue. So we will tell you all about that. So first, in terms of the fast-growing market and improving fundamentals, as I mentioned, first thing, increased CO2 targets. As I said, virtually every major company in every country in the world, just in the last 6 to 12 months, has increased aggressive carbon emission reduction targets. They've increased their carbon emission reduction targets by 2030. So, as an example, the EU increased, their target was a 40% reduction in carbon emissions by 2030. It's now 55. The UK went from 40% to 68%. The US and Canada have both announced aggressive new targets for carbon emission reduction. And a couple of examples from boom companies here. PepsiCo, 75% target to reduce carbon emissions by 2030, Nestle 45 to 50% reduction. So virtually everybody's on the same page here. Everybody is looking for quick, fast ways to reduce their carbon emissions, and that's what we deliver. The second big change, obviously, in the last 6 to 12 months is the change in administration in the US. You couldn't go from two totally different, there couldn't be two more different administrations, certainly when it comes to climate change and addressing climate change. One of the quotes that I saw early on that I quite liked is the new administration was not only going to make carbon emission reduction and climate change the center of job recovery and economic growth policy, but climate change was going to be at the center of all policy, be it foreign, domestic, security policy. Climate change will be at the center of that. The very first day of the new administration, the US formally rejoined the Paris Climate Accord with virtually every other country in the world. So everybody is on the same page here. And then finally, increased investor demand for ESG and in particular carbon emission and carbon emission reduction. So BlackRock, as you may know, the world's largest asset manager, back in January of this year, in their annual letter, they announced that they want to see their companies and their investee companies do more and disclose more with respect to greenhouse gas emissions. And not coincidentally, the very same day, 60 major multinational companies announced that they would indeed do more and disclose more with respect to ESG metrics. So very strong market, the strongest we've seen it over the last 10, 20 years. So this is a slide that I love this slide because it basically tells you everything you need to know about the energy sources, uses, and flows. This slide is for the US economy, but most industrialized economy would not be too dissimilar from this. So down the left-hand side in the different colors, you have the different sources of energy. The different boxes and the different bands represent the relative amount of energy coming from each source. You then see those sources of energy flow through the economy. Some of it goes to electricity generation, then it goes out to the different sectors in the economy, residential, commercial, industrial. So you see the orange bar is electricity. Virtually everything else is thermal energy, heat energy, a fuel that's being used to create heat. That's what we deal with, thermal energy efficiency. Then out the other side of the diagram, you see something called rejected energy and energy services. Rejected energy is the energy that's lost somewhere in the system due to inefficiency. And so you can see the US economy is about 2/3 inefficient, about 1/3 efficient. So 2/3 of the energy that's coming in is lost somewhere in the system due to inefficiency. That's the energy that we're capturing and putting back. That's what we are addressing. And so this huge opportunity represented by energy efficiency resulted in the International Energy Agency to declare energy efficiency the world's first fuel. And there's a couple things they wanted you to focus on, or they kept a couple things they were trying to highlight by calling energy efficiency the world's first fuel. Number one, they wanted people to realize that the opportunity represented by energy efficiency is significantly greater than any other single fuel source. And you can see that just by the size of the gray box compared to the size of virtually all the other boxes. And the second thing they wanted us to do is, if we need more energy, the first place we should go is energy efficiency. So energy efficiency reduces the use of energy, reduces carbon emissions. It can have a much greater impact than renewable energy at a much cheaper cost. So Thermal Energy International, what we focus on is the industrial sector. So industrial thermal energy efficiency. And that's, I've highlighted the industrial sector with the blue box there. And you can see a couple of things. I mean, first of all, in the residential and commercial, thermal energy is about 50% of the total energy used. Electricity is the rest. But in the industrial sector, thermal energy is 80 to 90% of the energy used. So that's why it's a good market for us. And the industrial thermal market is 2 times bigger than the residential and commercial markets combined. So specifically, what do we do? Well, we design, engineer, and deliver innovative industrial thermal energy solutions using our proprietary technologies, which you see down the right-hand side. We develop projects in partnership with our customer, which are overwhelmingly large multinational companies, and we'll talk about that in a minute, with our experienced team of engineers. We deliver real value to our customers, 2 to 4 year paybacks with projects that will last 30 years. So you can see it's a pretty compelling return on investment for our customers. About 70% of our projects, 70% of our business is turnkey projects. Those projects tend to range from $500,000 to $2 million. And customized equipment is the rest. So if the customer doesn't want us to install it, most of the time they do, but if they don't, we can just sell a piece of equipment as well. Those orders tend to be sort of $10,000 to $500,000. You can see down the right-hand side, our suite of energy efficiency products, and we've acquired these over the years. The FluAce and the GEM, our original technology. The DryRex is something we're developing for biomass drying, so really renewable, energy, net zero energy. Then Heat Sponge and Sidekick we acquired a couple of years ago when we acquired a company in the US called Boiler Room Equipment. And then just a month or so ago, we acquired the technologies in green there from a company called SOFEM. So we acquired all the intellectual property of SOFEM International just a couple of months ago to add to our portfolio. So regardless of the customer and the situation, we have a technology that will work for them. As I said, we work in partnership with the customer. We're not a bid to spec. We don't compete in competitive pitches. We go to the customer, we show them a solution, we show them what we can do, and then we develop the project with them to meet their investment requirements and to meet their carbon or emission reduction targets as well. Okay, and so where do we do it? So we have a global presence. You can see the countries in green is where we've done projects, but the dark green is really where our strategic focus is. The black pins is where we have our own people. The orange are offices. So you can see we have offices, corporate offices in Canada, the US, and the UK. We have direct sales people and sales offices in 7 different countries. So we've delivered projects around the world, but our strategic focus is North America and Europe. Hundreds of projects completed in 30 plus countries spread across 6 continents so far. Now, this gives you a little bit of a sense of the type of projects that we do and the type of customers that we have. So I mentioned we focus on the industrial, and overwhelmingly, almost most strategically, we focus on large multinational companies. And a couple of reasons for that. Number one, the large multinational companies are the companies that have the very large energy intensive sites. So if they're using a lot of energy on a site, we can do a nice big project for them. And second of all, these are the companies that have hundreds of sites around the world. So once we've sold one product to one site, we then want to sell more products to that same site, plus more products to all their sites around the world. We develop these partnerships with them to roll out the technology in different sites around the world. Some examples of our recent orders. So across the bottom, we have some recent orders, and this a couple of things I want to highlight here. Number one, the diversity of sector. You can see across the bottom that we've done projects in almost every sector you can possibly imagine, but 80% of our business is in non-cyclical sectors like food and beverage, hospital, and pharmaceutical. And so you can see across the bottom, the first one is a food canning company that we did. The next one, a hospital, then a tissue, then a dairy, a brewer, snack food, tire, pet food, chemical, and then a food ingredients company. You can see that the project sizes are anywhere from $500,000 here to about 2.4 million. The payback is sort of 2 to 4 years, and it's diversified by geography in both Europe and North America. So what's our strategy? We've been executing, a very similar strategy for the last sort of 4 or 5 years when we did our strategic planning 4 or 5 years ago. And so it really there's 3 pillars to it. Number one, we want to leverage our existing high quality customer base. As I said, we've got a who's who list of customers with hundreds of sites around the world. We want to do more sites, work on more sites with those customers. We want to sell more products to those, to each of those sites. We want to increase our portfolio of complementary products, again, so that we can implement new projects. Once we've done one project with a customer, we want to do another project. And we want to grow our team and our global presence. That is putting more sales people, more engineers on the ground in different markets, strategic markets for us. And we want to do all of that both organically and through accretive acquisitions. And we have been doing it organically and through accretive acquisitions. You can see across the bottom, in 2020, 80% of our sales were repeat orders. We have been growing our product portfolio, as I mentioned. We've added, direct sales reps in the last few years in Germany, Poland, US Gulf Coast, and Latin America. And in terms of acquisitions, we completed the acquisition of Boiler Room Equipment in 2018, and in 2021 acquired SOFIM Technologies. So we have a good suite of technology to offer our clients. Now, what has that strategy resulted in? So I wanted to show you first the results just prior to the pandemic, so just over a year ago. So these are the results right up to our third quarter ending February 29th, 2020. So you can see that over the 5 years, we had a 31% compound annual growth rate. We ended that period with about $3 million in EBITDA and $1.7 million in net income. So, the strategy was definitely working. But then, of course, as we all know, it's getting tired now, but, COVID-19 did have an impact on our business. A lot of what we do, as I mentioned, is turnkey solutions where we're on site developing projects and implementing projects for our customers. So obviously when there's, site lockdowns and travel restrictions, it had a pretty significant business on our turnkey project business. So you can see that in Q4 of 2020, which was March, April, and May of last year, so the very first 3 months of the global pandemic, when there was a lot of uncertainty, nobody really knew how to handle it. So what did our customers do? They just shut everything down. So you can see our revenue in that fourth quarter went from $6 million the previous year to under $3 million. EBITDA from $1 million down to 31, but still positive EBITDA. We ended the year, May 31st, 2020, despite the global pandemic, with record revenue and with normalized profits. So $2 million in EBITDA, $1.2 million in net income. And then on our year-to-date basis, you can see it still is impacting our business. The revenues were down. The third quarter is February 29th, 2021. So that's the last quarter we've announced. Having said that, despite the impact of COVID, we are still profitable with about $1 million in EBITDA and $329,000 in net income. The other good thing, though, is that our gem product and our heat sponge product, which tend to be just a piece of equipment, those revenues, those sales are up significantly. So our order intake for those products this year and our revenue for those products for this year will be record levels because we don't need the same level of site visits. So it's really just the projects that are reliant on site visits that are being impacted significantly. Everything up is still up strongly despite COVID. To give you another sense of the impact, just to show you where we are now and what the impact of the pandemic was, you can see here that we took the average quarterly revenue pre-pandemic and then the first 2 quarters of the pandemic and the second 2 quarters of the pandemic. So you can see our average quarterly revenue pre-pandemic was about $6 million. For the first 2 quarters, that's Q4 and Q1 of 2020, Q4 of 2020, Q1 of 2021, dropped to less than half of that, about 2.8. But for the next 2 quarters, average quarterly revenue is about over $4 million. Same story with EBITDA, went from 700,000 basically to break even. But for the most recent quarter ends, it's averaging $500,000 per quarter. Same with net income. So, we're starting to approach our pre-pandemic levels as travel restrictions have eased and markets are opening up and customers are getting going again. But it's even better than that, because our order intake for our year end for the first 3 quarters of this year was up 87% from the previous year. And our order backlog up 75% compared to the same time last year. Now, admittedly, last year was a difficult year because there was some impact even prior to the global pandemic being declared. There was some impact, but you can see that our order intake for this year is very close to the $14.4 million from the year before. It's that $14.4 million in order intake that generated, the $24 million in revenue, the $3 million in EBITDA. So you can see, certainly from an order intake standpoint, we're getting back very close to where we were pre-pandemic levels. Cash position remains strong. Sorry, go back here. Cash position remains very strong despite the pandemic, of $4 million cash on the balance sheet, working capital balances of 4.2. So we've been able to continue growing our cash and our working capital throughout the last 12 months. So in terms of valuation, at the current prices, the market cap's about $29 million, enterprise value about 28, because we do have some debt, but we have net cash, positive cash. That results in an enterprise value to revenue that is pre-pandemic revenue, so of 1.2 times. The enterprise value to EBITDA under 10 times, earnings less than 20. And so if you believe that we're getting back to pre-pandemic levels, which I certainly do, and when you look at the order intake, when you look at the record revenues from some of our key products that don't require site visits, and you look at our customers trying aggressively to reduce carbon emissions, needing our help to do that, I think we're well on our way to pre-pandemic levels. And so to me, Thermal Energy's current valuation at 1.2 times revenue does not reflect either our proven growth and profitability over the long term. We've been growing this business profitably and consistently for a long time now, nor does it reflect the significant recent market improvements with a Build Back Better and aggressive carbon emission reduction targets. So to sum up again, just to remind everyone, a fast-growing global market with very strong fundamentals as a result of new aggressive carbon emission reduction targets, growing demand for ESG. We're an established company with a proven track record of growth and profitability and a who's who list of clients. And we have a compelling valuation right now. So it's a compelling investment opportunity. So Thermal Energy, proven, profitable, sustainable growth story with a compelling valuation. That ends the formal part of the presentation. And I would be happy now to answer any questions if there are any. I think you just can type in your questions in the Q&A box if you have any. Okay, while I'm waiting for those, I can go through just a couple other slides here, just to highlight our management board, long-term management, very experienced board of directors as well. But you can see, with the exception of myself and the CFO, virtually everyone is an engineer. It is a technology-based company, and an experienced group of board members, also who the majority of which are engineers and experienced business people. Looks like we have one question. Plans for China? Not really at this point. At some point we would, and the company has dabbled in China prior to me coming on as the CEO about 10 years ago. The company thought China would be a good market for it. China's, it's a massive market. But it tends to be, they're looking for something cheap. So occasionally we've gone to China, tried to find a niche for ourselves, and they always want something cheap. That's not what we do. We're not a low-cost provider. We're not a cookie cutter. We provide, high value technical solutions for our customers. So we would go to China, and we have gone to China where it's one of our customers doing one of their sites. So we've done a pharmaceutical company in China. We've done a beverage company in China, but that's for our own customers. Strategically, our focus is North America and Europe. And that's where we're generating most of our business. There's more than enough for us to do in those markets where, largely English is the language, where the laws are the same, and where we have offices. So China at some point, but not right in the immediate future. The next question is, are you planning to acquire more technology? If you are, what would be the type or the application? So we're always looking for technologies that we can sell our clients. We think we've got a very good suite now, especially given that over the last couple of years, we've tripled the number of technologies we have. So we're not as actively looking for technologies as we are looking for distribution, be able to, if we found somebody in Europe, as an example, that had a similar sort of business model to us with good contacts in Europe, that would be interesting to us. Having said that, we are looking at a number of different areas that are of interest to us. So we save energy by capturing heat. When we go to a site, there's always way more heat sourced than there is heat sink. That is, there's way more heat available than you can use it. So some of the things we're sort of starting to dabble in now is looking for ways that we can use that extra waste heat that doesn't have a source has a use on site. So Dryrex, as an example, is one of those things. Dryrex is a low temperature dryer. So we can take that waste heat that can't be used otherwise and use that waste heat to run this low temperature dryer to dry biomass, to use that as a renewable fuel, as an example. There could be other low grade waste heat to electricity technologies. Those are sort of things that we're thinking about. Yeah, you talk about potential and increased sales, but it's been about 4 months since you news released a sale. I'm glad to see this person is following our story. And so there's a long sales cycle. On one of the slides, I said it's 1 to 2, 12 months at least for a sales cycle. Those large turnkey solutions they take a while to develop with the customer, and you have to hit the capital budgeting right. So it is quite frankly, it's a lumpy business. So, we could get a bunch of orders and then we go a few months without large orders. Having said that, as I mentioned, our smaller orders, the sort of $10,000 to $500,000 gem product, heat sponge product, we've had record levels of orders. And we did announce that at the end of the year for our fiscal 2021, the year ending May 31st, 2021, we had record levels of order intake for gem and heat recovery. We're working on a number of projects with our customers, but during the pandemic, they basically shut everything down. They had other things they wanted to focus on then, that is keeping their employees safe, figuring out how they're going to deal with the pandemic. Now that sites are opening back up, we're actively talking to our customer, but it takes a while to get those projects fully developed. So it's a lumpy business, but there's lots of stuff that we're working on. Dryrex has been in development for several years or more now. What is the status of the opportunity with Dryrex? So Dryrex we've had that technology for quite a while. There hasn't been an opportunity at this point. But we continue to look at it. We think as customers continue to move away from fossil fuels as a source of energy, we're going to get more and more demand for renewable biomass as an energy source. And so we are working with a couple of customers as an option, but it's a long-term strategy for sure. So we still think it's a great solution. And the market is getting better and better for it. So people weren't quite ready to do it. You think about a few years ago, natural gas prices are at all-time lows. So now with carbon emission reduction targets, it doesn't matter as much that the gas prices are so low. People are looking for ways to reduce their carbon emissions regardless of the cost. Biomass and Dryrex is going to be one of those solutions. Another question, how much will SOFEM add to your growth? What time frame? Listen, SOFEM, as people may or may not know, SOFEM hadn't been really in operation for a while. It was dormant, so there isn't a pipeline of opportunities that we're looking at. We really acquired the company for the technology, for their and it's really amazing technology. It's there's a couple of perfect technologies that work well with us. So we're going to put that into our sales force and start developing those opportunities. So it's, I can't really say yet what the growth opportunity will be and when it will come, but we're going to start selling SOFEM product right away. So, hopefully we will have some sales fairly soon. With these large, diverse customers, how many are into multiple installs? Off the top of my head, I don't know, but I know there's a major food and beverage company where we have done about 13 sites, 13 to 15 sites. That sounds like a lot, and yet that's just one division in North America. This company has 4 major divisions. That's one division in just North America. We've got another multinational company that we've done 3 sites for. That's the pet food and the animal food company. We've got another dairy that we've done 2 sites for. We've got a pharmaceutical company. We've done 3 or 4 sites. It's overwhelmingly, as I think one of the stats in the presentation, 80% of our revenue was repeat orders from customers. Now, that's not always a second site. It could be a second order from an existing site, but most of our major customers that, I don't know what the percentage is, but that generates the majority of our revenue, we're in multiple sites at, or in discussions with multiple sites. A brewing company, major brewer, we've done 2 sites. No, it's 2 different brewers. We've done 2 sites, and we're now looking at a 3rd and 4th. So most of our business does come from those large multinationals, repeat orders. Listen, we're back on site completing projects. Yes, one of the questions: are all your engineers vaccinated and back on site completing delayed projects? I'm not sure where all of them are, but we are back on site working with our customers as needed. And we operate. We've got salespeople and sales across North America, Canada, every province and state, and then throughout Europe. And every country and every state is a little bit different. And so there's and it's an evolving situation as well. But certainly we are back developing projects as quickly as our customers want us to develop them. So I think we're back and we're very busy because customers are coming to us now. Like I said, it's been the last 6 to 12 months where all these customers, it was a global build back better approach. People want to reduce their carbon emissions. So it's interesting. Their paybacks aren't as difficult anymore, aren't as their investment hurdles are much easier to reach. So as before, as an example, they might have said, well, geez, we need a 3-year payback before we're going to do it. That might still be the case for most projects, but when it comes to carbon emission reductions, because they are publicly stated what their target is, and 2030 is not that far away, those paybacks can be much higher. So we're looking at bigger projects with our customers, more projects that they might not have done a couple of years ago. Now they will do because they are aggressively trying to reduce their carbon emissions. Institutional ownership and insider ownership. Very little institutional ownership. The company has a long history. It's been public for a long time, but it's historically, it's sort of, this is going back 10 years before I was the CEO. Overpromise, underdelivered. So we decided that we wanted to establish ourselves with a solid track record of growth and profitability before we actively went out to the market and started telling our story. So we just started an active investor relations campaign last January. So 8 months ago, 7-8 months ago. So that's really when we've started. So this is part of it. We're doing these conferences on a regular basis. We're trying to get our name out there. We now have a OTCQB listing. Insider ownership is about 10%. Now that's board and management. But the important thing to remember is all the original owners are gone now. And so that 10% is been largely, there's been a little bit of options, but overwhelmingly, the overwhelming majority, probably 90% of that 10%, maybe 95% of that 10% was purchased on the open market. So both the board and management believe in the story. I am probably the second largest shareholder, about 6 million shares. Almost all of those 6 million shares were bought on the open market, because I believe in the story and I believe in the company. Let's see here. How many of your major projects are conditional on funding incentives but being delayed by legislation delays? It's to be honest, I don't know. We do work with our customers in partnership with our customers to get funding where funding is available. But usually the funding comes first and then the project. They don't develop the project until the funding is there. It's sometimes the funding is there that makes them think of the project. Having said that, we do lots of projects without any funding at all. But certainly where there is funding available, it's our job. I tell my sales team it's their job to know what funding is available, where they are in their jurisdictions, where they operate, and they should be actively going out and learning how that funding is available, what funding is available, and understanding how our customers can access it. So that's part of the service that we provide. We certainly don't advertise that, but obviously if we can get a 4-year payback down to a 3-year payback, it's that much better. And certainly the carbon pricing models that are coming in, whether it's cap and trade or carbon taxes, that's only going to help us significantly. That's going to significantly increase the cost of carbon. That will improve the return on our projects even more. I think we're just about up in terms of time. I really appreciate all the questions and interest. Please contact us. We'd be happy to answer more questions, happy to meet one-on-one with you during this conference or after. So certainly don't hesitate to reach out and if you're interested. So thank you very much for your time. And that's it. I look forward to talking to you again.